Even though Spotify is the biggest music streaming service in the world, the company has never turned a profit. The business has never experienced a profitable year, and its losses over the years have totaled more than 4 billion euros. It would be reasonable to assume that Spotify is awash with cash for a firm that has not only upended the whole music industry, but also totally transformed the way people listen to music. The truth is that Spotify has never been able to earn a profit, which makes it the only software company to regularly lose money despite bringing in over 10 billion euros annually. In this video, we'll look at Spotify's latest attempts to improve the situation and assess the main issue behind the company's ongoing losses. Since Spotify has made its financials publicly available, it is no secret that the exorbitant royalties it must pay to other parties for music streaming are the core of the issue. These royalty payments are determined by a complex system of per-stream rates and revenue-sharing agreements, making it difficult for Spotify to control its costs effectively. Just 1/3 of Spotify's revenue from music streaming is left over after paying the music rights holders for about 2/3 of each dollar. This money covers Spotify's other expenses such as taxes, R&D, S&M, and G&A. Therefore, the most pertinent point here is not why Spotify is losing money, but rather why it gives right holders such a large share of its earnings. Can't Spotify bargain for reduced royalties given that it leads the music streaming business with a 30% market share? Sadly for Spotify, the response is no. This is because the three companies that make up the Big Three, Universal Music Group, Sony Music Entertainment, and Warner Music Group, represent a strong oligopoly in the music industry, with whom Spotify must negotiate as the party it actually pays the majority of its royalties to. These three businesses control 60% of the music publishing market and 70% of the music recording market combined. The other factor to look into is the substantial spending on marketing and advertising, as it competes for market share with other streaming services like Apple Music, Amazon Music, and Deezer. These marketing efforts have been successful in attracting new users, but they've also added to Spotify's overall expenses. In today's music streaming landscape, the convenience for consumers is clear, finding any desired song on a single platform. Yet this ubiquity poses a conundrum for streaming services themselves. With a global music catalog available to major players, competition devolves into a price war, eroding profit margins. While financial details from industry giants Apple, Google, and Amazon remain undisclosed, former Apple Music head Jimmy Iovine's assertion that streaming services operate in a margin-scarce realm resonates. The precarious financial state is an industry norm, but Spotify faces heightened risk due to a crucial difference in business models. Unlike tech behemoths, Spotify lacks supplementary products to bundle with its music streaming service. Apple's enticing Apple One bundle, featuring Apple Music alongside iCloud, Apple TV, and Apple Arcade, exemplifies a strategic approach. Customers benefit from bundled savings, while the company propels sales of its hardware. Google and Amazon follow suit with YouTube Premium and Amazon Prime bundles, integrating music streaming with their expansive ecosystems. Spotify, without hardware offerings, relies on standalone streaming. Collaborations with companies like Samsung, Hulu, and AT&T provide bundled services but entail shared revenues, limiting Spotify's profitability. While music streaming is Spotify's core business, its competitors capitalize on synergies, making it a minor aspect within their broader operations. In this unique landscape, Spotify navigates a delicate balance, striving for profitability in a realm where others find success through diversified integration. Think Spotify is the Netflix of music? Think again. While they seem like twins, their paths to profitability diverge wildly due to one crucial difference: content ownership. While both dominate their respective streaming markets, the distinction in content, music versus movies, serves as the linchpin for their financial trajectories. Spotify, a $30 billion enterprise, burns cash, while Netflix thrives as a profitable $200 billion giant. Netflix's early days mirrored Spotify's current plight. Relying heavily on licensing fees for content from TV and movie studios, Netflix faced a staggering 64% of streaming revenues going toward licensing in 2012, similar to Spotify's current 70% payout in royalties. The game changer for Netflix was the introduction of Netflix Originals in 2013, enabling them to own a significant portion of their content. This move drastically slashed licensing fees, propelling Netflix's profitability. Fast forward to 2022, where over 50% of Netflix's library comprises originals, reducing licensing fees to a mere 24%, even factoring in production costs. The total still stands significantly lower than the 2012 licensing expenses. Spotify's salvation lies in mirroring this model, akin to having its own Spotify originals, which could mitigate royalty payments and boost profits. However, Spotify faces a formidable obstacle: the music industry's early anticipation. Record labels securing their position, embedded terms in licensing contracts preventing Spotify from owning content. Over 75% of Spotify's music falls under the control of the big three record labels and Merlin, an organization representing independent labels, rendering Spotify at a disadvantage. The music industry's concentrated power, with the big three holding a 70% market share, limits Spotify's negotiating power compared to Netflix. In 2018, when Spotify attempted to license directly from artists, bypassing record labels, backlash ensued, forcing Spotify to backtrack. The movie and TV industry, with 7 major studios and less concentration, allowed Netflix to secure exclusive streaming rights with fixed fees, a luxury Spotify couldn't attain with record labels. The crux lies in the supplier concentration within their industries. Netflix navigated a landscape with more negotiable suppliers, while Spotify contends with an industry oligopoly. Despite Spotify's musical prowess, its challenge lies not only in negotiating profitability, but also in liberating itself from contractual binds to truly harmonize its financial score. Major record labels have tightened their grip on Spotify, slashing its share of streaming revenue from labels from 38% in Q4 2017 to 31% by Q2 2021. Spotify, hungry for profits, is breaking free from the music industry's iron grip by diving headfirst into podcasts. They see podcasts as the golden egg, boasting lower costs and higher margins than music. But will this gamble pay off? Spotify is pouring billions into acquiring companies and securing exclusive deals with celebrities like Joe Rogan, Kim Kardashian, and even the Obamas. The logic behind this shift is clear. Podcast streaming costs less than music. Spotify predicts a robust 40 to 50% gross margin for podcasts compared to the current 25 to 30% for music. The gamble is that as podcast consumption rises, the proportion of revenue allocated to music royalties drops, theoretically boosting overall profitability. Surprisingly, Spotify's data reveals that podcasts actually increase total streaming time, even if music listening dips slightly. However, the financial picture remains murky. Despite Spotify's optimistic predictions, the first half of 2023 has been even more unprofitable than the same period in 2022. Has Spotify's podcast gamble backfired? Only time will tell if podcasts will truly be the key to their profitability dream. Despite years of prioritizing growth over short-term profits, Spotify faces a daunting reality. Bottom-line profits are imperative for long-term sustainability. With the music streaming landscape proving challenging for profitability, compounded by podcasting falling short of expectations, Spotify's path to meaningful profits appears elusive. The music industry's oligopolistic structure, dominated by record labels, continues to hinder Spotify's financial success. In response, the company strategically emphasizes growth as a narrative, deflecting attention from the persistently negative bottom line. This narrative serves as a buffer, affording Spotify time to explore alternative monetization strategies. However, the absence of substantial changes leading to substantial profits may test investors' patience, potentially pushing Spotify into the arms of big tech through acquisition. Recent actions, such as layoffs and price increases in 2023, reflect Spotify's attempts to navigate its financial challenges. Layoffs, while impactful, have limitations given that wages represent only a fraction of the towering music royalty fees, dominating Spotify's costs. Price hikes, a potential avenue for higher profits, are constrained by the industry dynamics. Given the similarity in content among streaming platforms, prices are industry-driven, forcing Spotify to follow competitors' leads. The recent price increase in July 2023, the first in over a decade, occurred after industry heavyweights Apple, Amazon, and YouTube made similar moves. As Spotify treads a delicate balance between growth narratives, cost-cutting measures, and price adjustments, the challenge lies in transforming these strategies into tangible profitability. The company's financial fate hinges on its ability to innovate and reshape its revenue model, as the pressure from investors and the relentless pursuit of profitability heighten in the ever-evolving landscape of the music streaming industry. In the ongoing Spotify profitability saga, the spotlight often fixates on the freemium model, with speculation about ditching the free tier in favor of an all-premium approach. However, the real heavyweight in the ring isn't the freemium debate. It's the epic struggle against the major record labels tightening their grip, devouring a whopping 70% of Spotify's revenue. In this David and Goliath scenario, music streaming, no matter how cleverly packaged, seems an unlikely hero in Spotify's profit quest. Ironically, the disruptor finds refuge in diversification, steering away from its musical roots that once revolutionized the industry. Spotify's predicament unveils a captivating narrative of industry dynamics dictating a tech titan's profit potential. When suppliers wield colossal power and rivals sling similar products, the formidable cocktail of unyielding costs and a lack of pricing prowess becomes a profit Pandora's box. Will Spotify find a way to break free and sing the song of profitability? Or will they remain forever trapped in the golden cage of the music industry? Only time will tell if their melody changes to one of triumph or resignation.